Why does a private equity fund have both a general partner and a management company? I get this question a lot, so let's dive in. You might recall from the video lesson titled Private Equity Fund Structure, which I recommend watching if you haven't already, that the private equity firm, also known as a financial sponsor, is made of a team that will identify, execute, and manage investments in privately held operating businesses, and that this is comprised of a general partner and a management company. The general partner, or GP, is the entity with the legal authority to make decisions for the fund. And this entity also assumes all legal liability. The management company, which is also known as the fund manager or investment advisor, is the operating entity that employs the investment professionals responsible for allocating capital and managing investments. The management company is generally affiliated with the GP, but they are not the same entity. In fact, the GP will enter into an agreement with the management company, and under this agreement, the fund pays the management company fees to employ the investment team, evaluate opportunities, manage the portfolio, and manage all day-to-day operations. Now, why is this valuable? Well, as you raise consecutive funds, you start building knowledge and proprietary information, systems and processes in the management company. And this becomes hugely important to the private equity firm's success. One large fund that I spoke with recently in New York City with more than $20 billion under management told me that they employ an operations team of 55 people to help their portfolio investments. All of these people are employed by the management company, and they help portfolio companies across multiple funds. The partner I was talking to told me that they will not get involved if they have to replace the management team. They're just looking for really solid companies. But even excellent management teams can use a little extra horsepower and bandwidth sometimes, and that's where this team of 55 additional operators comes in. Now, you need a lot of fees to pull this off, but it's an incredible resource. And it's also a selling point when they approach a new investment opportunity and when they're raising new funds, largely because they have a track record that they can point to of helping great companies outperform their peers. And I think it's important to emphasize the value this carries when a firm is raising capital. Think about the additional comfort an investor feels when they know the fund they are investing in has a management company with deep resources attached to it, versus the confidence an investor has to have in a first-time fund with no background or history of success. As a private equity firm scales, this structure allows the management company to work across multiple funds while still having a GP for each fund. Over time, the same management company could be affiliated with a handful of funds. Think about it this way. The management company owns the firm's branded assets and intellectual property, which include the name of the firm, the track record, and any proprietary processes the firm has developed. And all of this helps the management company build goodwill across funds. In summary, each new fund must have its own general partner, but the accumulation of knowledge and processes resides in the management company, providing the private equity firm with economies of scale. If you want to learn more about private equity transactions, check out the private equity training curriculum available at ASM. All right, team, that's all for now. Thanks for watching.